Hello and welcome to the Southern California Economic and Housing Market Update for the week of May 20th, 2020. My name is Jordan Levine. I'm the Deputy Chief Economist here at the California Association of Realtors, and I'm excited to share this update with you today. So since we last spoke, we've gotten more data coming in, and the data is still pretty ugly. We've seen unprecedented impacts to the three areas that we care about most from a macroeconomic standpoint as it relates to the housing market, both the labor market impacts, consumption impacts, and then those, of course, are bleeding through to the overall GDP number, which, of course, is just the representation of how much income is being generated by our economy at any given point in time. And this is obviously having impacts for us here in the California housing market. President Truman always wanted a one-handed economist because his economists were always kind of telling him on the one hand, things were good, but on the other hand, you have to watch out. And unfortunately, I'm speaking to you as a two-handed economist today because in some ways we're starting to get signs of a bottom. And in fact, several key indicators have even started to move in the right direction. And yet, when you look at the picture for closed sales, and even for prices, the effects are largely lagging behind what we see happening in these more forward-looking indicators. And so while things, are starting to look like we're seeing some light at the end of the tunnel on the one hand, on the other hand, we have to be very cautious about over-celebrating, and we'll talk about why there's still a fairly long row to hoe on this one. So let's talk about the labor market impacts thus far. Now the numbers are up to almost 37 million folks have filed for unemployment insurance since this began a little under 2 months ago. Just to put that into perspective for you, that is basically equivalent to the amount of folks that we saw file for unemployment during the kind of 18 to 20 month period between the beginning of 2008 to the midpoint of 2009 during the Great Recession, which was the deepest economic recession since the Great Depression prior to the one that we're seeing right now. So really unprecedented impacts to the labor markets. And of course, when folks aren't out there working, then that has income impacts for those individuals, which then creates what the econ nerds like me like to call the multiplier effects that show up as lost consumer spending and business revenue for everything that's downstream of those jobs. And indeed, we saw in last week's retail sales number that we had an acceleration in the hit to retail spending, which was down on an annualized basis by almost 90%. And so these are record numbers. We've never seen this big of a retrenchment so quickly on the consumer side of the equation. And, as go consumers, so goes the economy, with an economy that is still almost 70% consumer driven at this point in time, and even in the pre-crisis environment. Of course, I mentioned that we are starting to get a sense of where the bottom is, and that is a bit of a change of pace from where we were when we were last together about 2 weeks ago. And you can see this in our weekly survey of realtors, which just closed on Monday, the 18th. And the percentage of realtors who are seeing buyers pull back or withdraw offers from properties that they had been ready to move forward on is down from almost 50% about 4 weeks ago to just 37% over the weekend. And similar story on the sell side, with basically almost half of realtors reporting that sellers have not just gotten cold feet, but withdrawn the property from the MLS. That number is again down from where it was about 4 weeks ago, when that was nearly 60%. And so still seeing those impacts persist on the market. We're still talking about 2 out of 5 buyers on the buy side and almost half again of sellers on the sell side. And yet those numbers have both come down from where they were in the kind of mid-April timeframe. We see a similar story for consumers. When you ask about good time to buy, there's a perception that with low rates and potentially even discounting happening, that it's actually a better time to buy than it was a few months ago, at least according to this sample of 1,000 consumers that we spoke to in early May. And when you contrast that with the sell side of the equation, we've actually seen deep retrenchments, but actually after falling by about 50% from almost 62% saying that it was a good time to sell in California down to 26% in April, that number does seem to have lost some downward momentum as it increased slightly in May. It's still depressed relative to where it was pre-crisis, but again, getting a sense that those numbers are starting to find some semblance of a bottom. Here in Southern California, you can see that pending sales dropped off significantly, falling by almost 50% by the time we got into the mid-April timeframe, and yet over the last 4 or 5 weeks, we saw pending sales start to regain some of that lost ground. The reason why we don't want to over celebrate that and that we know we still got a fairly long way to go is that over the last 2 weeks, you can see that that growth really decelerated. And actually, we had a decline in pending sales for the first time in about 4 or 5 weeks here in Southern California. And so things are moving in the right direction, but they're definitely not rocketing back to those pre-crisis peaks. You see a very similar story on the listings front that we see in pendings. Precipitous declines by the time we got to mid-April, with recent growth over the last month where we've started to pull back some of those losses that we experienced as the shelter in place really ramped up. The reason why we don't want to celebrate, and again, we can see over the last couple of weeks that the growth in new listings has really lost some momentum. And in fact, we actually had a decline here in Southern California for the number of new listings in the most recent week. So we're seeing things move in the right direction, and indications are that they'll continue to move in the right direction. But here in Southern California, we're not seeing things just rocket right back to those pre-crisis levels. And so ultimately what this means is that belt tightening mode will continue for at least the next couple of months and likely, into July, even as the economy starts to reopen and even as we see those numbers on the pending side and the listing side start to move in the right direction. Here in Southern California, we're only just now seeing the numbers for closed transactions finally catch up with where pending sales numbers were this time in early to mid-April. And so even as things gradually start to move in the right direction, we need to keep in mind that they're A, moving in the right direction slowly here in Southern California, and B, it takes a while for that pipeline to actually manifest as an increase in closed transactions. And of course, on the price front, we've seen only minimal impacts thus far. We were up in the April data 0.6% on a year-to-year basis, and only down 1% on a month-to-month basis. And so prices have been really holding up well relative to the size and scope of the economic impacts. But when you look at it from the standpoint of buyers, they are expecting price reductions to be coming down the pike. And in our survey that ended on Monday, the 18th, we saw that we're still getting over 80% of realtors with clients who actually are expecting lower prices at this point. And so we're seeing a bit of a battle of expectations. And when you look at it from a list price standpoint, you can see that list prices are holding fairly steady. We have roughly the same 29% of active listings that have been reduced as we had pre-crisis. And yet when you look at the numbers on the closed sale side, you can see that recently we have seen a bit of an uptick in the percentage of closed transactions that had to eventually come down or did come down ultimately during that escrow process. We saw some early impacts to prices through the end of March and midpoint of April, but actually prices have been pretty stable over the course of the last month or so in Southern California. And yet we see those closed sale prices coming down in bigger numbers from where they were relative to original list price. And so I think we can expect soft prices here in Southern California, at least for the next couple of months, especially as we continue to open up very gradually. And so when we think about the ABCs of the economic recovery, whether it's going to be a V, a U, a W, I would offer up the potential that we're going to have a J-shaped recovery, and that recent growth that we saw in pending sales, in listings, was really a catch-up effect from an overcorrection, and that now we're entering the kind of slower growth phase of the J-shaped recovery, where we've still got, even as we gradually start to open up, industries facing ongoing restrictions, and it's going to take us a while to adapt and figure out how to do business in this new normal, even as things start to move in the right direction. When you look at the new listings or the pending numbers, I think we are seeing that J-shaped, where we had this bounce back over the course of the last month, but lately in the last 2 to 3 weeks in particular, that bounce back has really petered out. And so I think that, again, look for that J-shape for a recovery and not a V or a swoosh or something like that. When you look at our current forecast for the economy as a whole, we're looking at around 30% GDP hits, assuming that the economy gradually reopens, that there's no double dip in the financial markets, that there's no second wave of the virus. All of the other asterisks and caveats and et cetera is on there, but this is one scenario. And if we do hit that 30% growth number, we're looking at about a 35% hit to close sales, which we then start to claw back during the third and fourth quarters, such that we end up, when the dust settles, with a 2020 closed sales environment that's down 16.7% from where it was in 2019. From a price standpoint, we do expect that prices will be impacted. It's just taking a while, but we expect those prices to remain in the single-digit territory. We don't have the same fundamental problems that were under the surface of the economy back in 2008. This crisis is unprecedented, and it will hurt, and it will show up in closed prices. It's just not going to be on the same level that we saw back during the financial crisis of 2008. So if we put it all together, we're still seeing data come in that is pretty ugly in terms of the labor markets, the consumers, and the economy at large, and that's obviously playing itself out in the housing market. The good news is that we're starting to get a sense of the bottom and see those declines really start to lose momentum, and in fact even start to move in the right direction in several key areas. Keeping it really real, though, that initial bounce back is losing momentum. And so I think we're looking at something more like a J-shaped recovery than we are a V-shaped recovery, and looking at getting back to those kind of pre-recession trend lines by mid-2021. So moving in the right direction, but it's going to take us a while. We'll obviously have to revisit these forecasts if there's a second wave of the virus, a double dip in financial markets, or any other major shock comes down the pike. But we're starting to see those lights at the end of the tunnel. Way too early to start celebrating, but we are seeing some positive indicators out there. So thank you for tuning in for this update, and we'll see you in a couple weeks.